Great. Well, welcome everybody. We're so glad you're here. We're talking about the most fascinating and new initiatives in the tax space, and everybody cares about that because we're worried with this new administration, what's going to happen with our investments, what's going to happen with taxes. And so we've picked some experts here to help us weed through what's going to happen. And so we're going to get started today. So I want to thank my panelists. So we've got Adam Carver from BitGreen. We've got Julio Gonzalez from Engineered Tax Services in the Gonzalez Family Office. We have Heidi Henderson, EVP of Engineered Tax Services. So what we're going to do is have everyone go around and introduce themselves. And then we're going to have some presentations and slides and a discussion about all the interesting opportunities there are. So why don't we start? Adam, why don't you kick it off, give a little bit of your background, and then Julio and then Heidi will go next.
All right, love going first. Well, thanks for the invitation, Alexander and Katherine, for inviting me here today to present. My name is Adam, and I'm the co-founder of a technology fintech company named BitGreen, and we also have a separate company that's named SunSaver, where we organize tax-efficient and optimized strategies using investment tax credits issued by the U.S. Treasury that enables wealthy individuals to reduce their federal tax burden by anywhere from 15 to 30 and 40%. So I'll be discussing that strategy with you later on. And I'm based in New York. I used to work in structured finance for Morgan Stanley. I was a venture capital investor for a little while before becoming the CEO of BitGreen and SunSaver.
Well, and Adam, I love what you're doing. I think, a lot of people don't realize that there's those opportunities to buy down their taxes or mitigate their taxes with the product you have. So it's glad to be on this panel with you. And just real quickly for me, I've been doing taxes I started my career in 1980 and then started Engineered Tax Services in 2001. And really, working in the big accounting world, you get the opportunity to work with private equity firms, hedge funds, public corporations, and you see at a high level what we were doing as an accounting firm to mitigate their taxes, eliminate their taxes many times. And in 2001, we started Engineered Tax Services to really create tax equality and be a resource to the accounting firms across the country. We work with several thousand accounting firms, and we work with them to utilize tax credits, tax incentive grants, certainly things that they typically weren't bringing to their clients. And these are the things that help lower their taxes, mitigate the taxes, things that Adam's doing as well. And ultimately, preserving these small business owners' wealth. So tax equality, we're working really hard to democratize the tax code every day and be a resource to the accounting community so they can better help their clients with all kinds of different strategies. And so great to be here and great to be on the program. I would say this, though, just real quickly. I think, the tax policy is going to be good for the next 4 years for the small business community. I think we'll get some of these tax credits reinstalled, and I'll hand it over to Heidi to introduce herself.
Thanks, Julio. Thank you again, Katherine, so much for having us here. I am Heidi Henderson. I'm with Engineered Tax Services as well. I have been working with Julio now for just over 13 years. And I call myself a reformed accountant. I have a master's in tax, and I love Julio's entrepreneurial spirit and his constant drive to solve problems and innovate. And that is not something you find commonly in the tax and accounting world. And one of those differentiators as to what he has built and what we've been driving with Engineered Tax Services and our family office groups to really optimize tax efficiency, to identify alternative tax investments and options, especially in a changing tax and CPA industry. It is such an incredible time. There has been more change in the CPA world itself over the past 18 months than I personally have seen in over the last 20, 25 years. And it's really coming out of need. It's looking at taxpayers, individuals, ultra high net worth, family office, business owners who are realizing that there are opportunities within the tax code to incentivize particular actions that really drive our economy and drive success, and that those incentives are really there to provide benefits for people who are willing to take the risk of investing in certain alternative options. And the benefits are just significant. And so our goals with engineered tax services, to Julio's point, is to democratize those and essentially bring them to every level of taxpayer, from our Fortune 100 companies all the way down to a couple living in California that are professionals and are now making 7 figures paying 50% tax. They're saying, how can I take my $400,000 or $500,000 of tax liability and roll this back into alternative and other investments to grow my wealth and become generationally successful and build something? It's looking back at that American dream, and it is going to be an interesting time in the tax world. So Katherine, do you want me to kind of start and go through some slides, or how would you like to take it from here?
No, I think that would be great. It would be great if you could share your slides. That would be awesome.
Let me share my screen really quick. We'll get this started. We have just a few slides. Bear with me as I change screens. Okay. So a couple of slides. Julio is blessed to be incredibly well connected. We have amazing groups in DC who are constantly working on and keeping their thumb on the pulse of what's happening in DC. And particularly after this election, we are anticipating, as Julio had said, some very major tax policy changes. Our groups in DC are providing us with up-to-date, minute by minute. It's like we've got the media stream of what's happening and what conversations are already starting to happen on Capitol Hill, what discussions are underway in terms of what the expectations may be and what we're looking at. So at a very high level, just to give you kind of that legislative update, after we'll go through a couple of these slides, we can dive into some of the really pertinent, particularly what Adam is working on with the investment opportunities and some of these tax credits. But from a high level, major tax legislation, we are highly anticipating that there is going to be a comprehensive new tax plan that will be promoted and pushed through likely early 2025. How do we know this? We are headed towards what is called the tax cliff of 2025. That is the expiration of the Tax Cuts and Jobs Act, tax cuts that occurred in 2017, and many of those things are falling off. There is something like 27 to 35 provisions or tax cuts that are expiring in 2025. And that will or would result in dramatically different or higher tax rates pretty much across the board. And so those provisions that are expiring are not only going to increase tax rates, but it's really a heavy burden on businesses and things like the R&D credit. It's also something that we specialize in that have been dramatically impacted by some of these changes. So that looming tax cliff that we're approaching is causing some alarm and some sense of urgency for creating these provisions and preparing to pass a bill. The Trump administration and Congress want to incentivize U.S. manufacturing. They want to bolster supply chains and competitiveness. The R&D credit, as I mentioned, is one of those things largely applicable to any type of development and innovation within the U.S. that really is funding that activity. But there has been a tax bill that has needed repeal for almost 3 years and has been pending. So again, huge sense of urgency to push through a change on that particular bill to re-incentivize U.S. manufacturing and supply chain issues within the United States. And the R&D credit is one major way to do that, as well as many of the things that we've heard throughout the election. The big tax bills are far and few between. There's a pent-up member appetite to consider their policies. There's interest in rolling back the Biden-era policies like clean energy. So that will be interesting because the IRA bill certainly had many, many provisions in there that are also coupled with some wage bills. So a couple, again, that we work in, 45L tax credits, 179D deductions are both very specific to real estate buildings that are energy efficient. And those incentives specifically drive new developments. They drive energy efficient building improvements. And one is a deduction, one is a tax credit. The IRA bill actually coupled that then with a wage bill that then is also requiring Davis-Bacon wages, so increased wages and apprenticeships, which has caused some lack of application of those credits. So maybe looking at a rollback on some of these Biden policies may actually free some of that up to, again, reinfuse the multifamily space and the industrial space to capture some of those incentives. With GOP control of the White House in both chambers, we expect use of the budget reconciliation process to pass that, which only requires 51 votes in Senate, not the usual 60. The budget reconciliation is an arcane process that limits what can be included. Even with only a majority vote requirement, it could snag the process, but there is an expectation that they will be likely capable of passing a bill. What's expected in the tax package based on what we're hearing and current conversations, what won't be included, a big tax increase on large corporations and the wealthy. So no billionaires tax would be expected from what we're hearing. We expect policies to grow the economy, to create jobs, to bolster US supply chains and competitiveness, and to deter outsourcing and imports. Again, research and development, the incentives have been waning over the last 2-3 years. So we expect to repeal to that, which will reinfuse the R&D credit. Just from what we would like to support, we've not heard that this is going to happen, but there's always some discussion of making the R&D tax credit a refundable tax credit. I like to give the example that the R&D credit is a tax credit funding businesses who are doing innovation, creating new products. In the United States, it nets about 6 to 8% tax credit. It is not refundable, so it will reduce the tax liability for that entity. But to put it in perspective, the tax credit in Ireland is a 60% refundable credit. In Canada, it is 40% refundable credit. So when you look at that in comparison to the United States, which is 6% non-refundable, and how we compare, it's clear why businesses like Apple do much of their product development in Ireland and other countries. So if we really start to look at that and drive competitiveness through incentives, this is a huge vehicle to do so. Chair Smith priorities are small business, family farms, individuals, all who need to meld more with the traditional GOP priorities, which are supported by the White House. The goal is to keep the corporate tax rate low or reduce it further. We're looking at likely Tax Cuts and Jobs Act extensions, which would be extending the individual tax cuts, extending the 199A pass-through deduction, restoring full expensing, which is 100% bonus depreciation. We have a million questions, is bonus depreciation coming back? And we certainly expect that it will. It is currently 60% for 2024 and drops to 40% next year. So hopefully we'll see that reinfused to 100%. We expect an extended larger estate tax exemption and then raising the SALT cap as well. The IRA, there is discussion about repealing certain corporate alternative minimum tax limitations and repealing the stock buyback excise tax that was pushed through in IRA. So those are a couple of things that we are looking at and have an anticipation that we may see. What else is expected for an entity of concern? Some other reforms, disaster relief. There's a few other affordable housing credits, the child tax credit, maybe retaliation against Pillar 2, digital service taxes. These are just a few things we're hearing. There are some discussion points. And then how do we pay for it? That is always the question, is how do we pay for the tax cuts? And those offsets that are being discussed are looking at tariffs and proxies on tariffs, repealing or clawing back some of the IRA clean energy provisions, an excise tax on endowments, Build Back Better. Cutting Room is kind of looking at discussions, and maybe some other creative surprises. So our group, again, in DC is saying, don't be surprised because anything can happen, and it's going to be an interesting time. We can expect that the Biden administration may work on finalizing some regulations before January 20th. So there's some urgency there to try to push some things through. It could be rescinded to rescind some regulations which have been finalized by that prior administration. The executive branch, the Trump administration, can reopen regulatory projects. They can reissue sub-regulatory guidance, can issue some executive orders. So there are some things that may hold up certain actions that might be taken prior to January 20th. We also expect in the courts there may be some challenges to some regulations pursuant to these two cases. The Chevron case is really significant. If you're not familiar with this, it could be very dramatic as it relates to certain tax law. There was a case that really is supporting the fact that as taxpayers, we have the right to be before a court that is independent and not just run by the IRS. And that gives it an independent flair. So there are some cases under audit that have maybe changed what we're looking at in terms of how large audits will be handled. And we'll be excited and expectant to see what happens there. So what do we expect? The Republicans are formulating the tax package now. They're in the heat of discussions and building this right now. We'll have to tune in for Julio and see if he is having those conversations and contributing, as he was very instrumental in the Tax Cuts and Jobs Act. Julio, I see your camera back on. Do you have any comments on your involvement and feedback for what you're hoping to see in the new legislation?
Yeah, Heidi, I thought you did a great job. I mean, that was outstanding, those slides and some explanation there. I also think that, I'm working with the Department of Government Efficiency, DOGE as they call it now, right? And I think, when we're scoring this, like you said, how are they going to get the cuts somewhere to pass these or extend these tax benefits to the small business owners and individuals? I think we'll see some of that through some slashing of budgets from different departments in Congress. So I think that's one element to help with, I think they see a lot of waste there. And if we can eliminate that waste, obviously, then we don't need all those tax collections, right? And we can do some of these cuts that are going to help the individual small business owners. So I would share that with you, but I think that was a great explanation. And I think that to basically the tax cuts that were set up in 2017, we don't have to do a reconciliation process. Typically, you go through to do tax policy, change tax policy. So I think that could get done in April or May. We think May at the latest. I also think that maybe they'll extend that back so that if you miss the opportunity to take those in 2023, 2024, that may come back. And certainly I think they're going to try to make it permanent so we don't have to go through this, roller coaster of trying to have tax cuts and then they expire and then we have to bring them back and then Congress can't get together on certain things. We saw that, right? We tried to bring the tax cuts back last year and they couldn't reconcile because, the parties just didn't get along there. Well, the parties are aligned now, so they should be able to get this stuff done pretty quickly. And so I think that's good for all the small business owners. And I think we'll have a good idea in late January what the timeline is going to be for those things.
Exactly. Yeah. There is a lot of thought that legislation could very well move within the first 100 days of the new administration. That may be optimistic, as they're letting us know, well, it could drag out. We know how these things go. We are also asked constantly, will it be retroactive, particularly with bonus depreciation? And that's an unknown. Certainly would be nice if it is retroactive to 2024, but it certainly would be applicable for 2025 as we get some of those things passed. As I said, don't assume any tax deduction, credit, or attribute is safe. The tax reform is real. They are diving in hard and fast on this one. And we are keeping abreast of what's happening daily. So follow us, Julio's very active on social media, as well as our company pages, and really trying to bring information to the forefront. So with that said, tax planning has never been more important and more valuable. And to circle this around and then bring Adam in shortly, what we're seeing, as I'd mentioned before, tax rates have continued to rise. Looming phase outs of tax cuts has increased liability. It's increased concern by a lot of taxpayers. CPA firms are overworked, they're understaffed, and they're really trained to focus on compliance and accuracy of filing returns. Typically, they're not looking at advantages. They're not looking at strategy. And so that's really where we have had the largest requests from our clients. We've seen the most discussion in the space of asking, I know Julio is seeing it every single day, what can I do as a taxpayer? What should I be aware of? Those valuable things, real estate still is one of the most incredibly tax advantaged options you can make as far as tax mitigation strategies. Cost segregation, especially if we have 100% bonus depreciation back, there's almost nothing that's more fundamentally powerful than direct real estate investments. We do see that coupled with oil and gas investments that can also offset ordinary income and become active. We have multiple tax advantaged entity structuring and complex strategies to help handle how our assets are then passed on from generation to generation. And then diving into some of these solar and sustainability credit options and, you know, the plans that Adam has put together and the structure that he's built is really, honestly, the best that we've seen. We are approached every single day with providers who have different plans and programs. Kudos to Adam, but he really has a great program. We have a lot of trust in what he's built. So with that, you know, let's dive into some of these specific strategies. Like when we're looking at tax planning, here we are, we're coming into the first part of December. We have not finished out 2024 yet. It is not too late to actually deploy some of these strategies and reinvest those monies that typically go to the IRS. How do we take those, roll them into investments to give us higher returns and make that money go to work for us? So with that, Adam, I think you're the guy to tell us more about that.
What a setup. What a setup. I feel like my mother put you up to saying that. She's blushing right now. Well, even more of a setup. That information was incredibly insightful and valuable from both you, Julio, and Heidi. It's as though you stacked the basis for me to hit a home run right now. And then we'll come right back after my very quick presentation on one specific strategy, and we'll have a more comprehensive discussion. So here we go. I'm going to share my whole screen here because I'm going to reference something that Heidi had said a moment ago. So again, hi everyone, I'm Adam, and I'm the CEO of BitGreen. BitGreen is a fintech platform that helps to provide financing for a variety of alternative markets and impact investing markets. But one brand and one entity that we launched is named Sunsaver, which specifically focuses on a very narrow and seldomly understood change in the US tax code within the last 12 to 18 months. And very few CPAs and chief investment officers actually picked up on it, which is why this may be new information for you. Yet most of corporate America and the array of tax directors and treasurers at C corporations are currently taking advantage of this program. So in the theme of trying to democratize or really propagate that type of wisdom and strategic opportunity for members of Katherine and Alexander's community, they had asked me to share this strategy with you, and Heidi and Julio have been very good partners. And for us, that brand is, we execute the strategy under the brand of Sunsaver. Now, I'm going to open with a question that inspired me at Katherine's and Alexander's previous event in October. A woman was presenting from JP Morgan on wealth preservation, and she spent 30 minutes discussing a variety of alternative and comprehensive strategies, some more complex than the other, in an attempt to eke out 5 or 6% market return every year. And the thought occurred to me, why take market risk only to earn a 6% annual return when you can take no risk and reduce your taxes by 10 or 20 or 25%, at least to start. And that ought to be the Hippocratic oath of capital preservation and tax planning. First, don't overpay your taxes, right? And then afterward, as a second conversation, talk a little bit more about optimizing investment portfolios. Now, Heidi said something that was very interesting, and what you're probably hearing a lot, or you heard in the run-up to the election and now after the election, is a significant amount of saber rattling from the GOP that they're going to cut the Biden Inflation Reduction Act and wipe the Democrats the last 4 years from the record. But the reality is the Inflation Reduction Act generated substantially greater benefits for GOP states and GOP congressional districts than for blue states. And this is this map obviously is pre-election, so you see Michigan is blue, and you see every one of these states were painted red by November, the election on November 6th. But the point is that of the 405 new manufacturing projects that have been initiated in the wake of the Inflation Reduction Act, only 2 years old, and you're talking billions of dollars of investment, 65% of those projects have all been created in GOP states. And actually in this scenario, Michigan is not even counted, even though it's now red. And 85% of the jobs that have been created by the Inflation Reduction Act have occurred within GOP and Republican districts. So as you might hear and observe the conversation on a variety of news channels and in the media about the Inflation Reduction Act getting curtailed, the Inflation Reduction Act is broad. There are many different programs, but the core programs that relate to the strategy that I'm about to introduce to you are very likely, or at least their bones, are very likely to persist in a new administration. So now let's talk about that strategy. Oh, and this is me. It's a biography in case Katherine and Alexander want to share these slides later. So we're going to talk about the concept of tax equity and tax credits for infrastructure and renewable energy. Now, the key here is, although I'm talking about a novel change in the tax code over the last 18 months, the truth is this strategy has been around for decades, and I'm sure that Julio and Heidi have actually executed on this long before the IRS issued guidance on the Inflation Reduction Act only in June 2023. That's how young the IRA is. However, the Inflation Reduction Act made tax equity optimization more accessible, particularly to wealthy individuals, right? And that was one of the key changes that occurred under the IRA, including amplifying the benefits that were available. So really, we're talking about what is tax equity. It's a very strange term, but the core idea, the concept here, is that it enables you to channel your tax liability into an investable asset, or you repurpose the liability that you would otherwise pay to the IRS. And obviously, when you pay the IRS, your return on investment is negative 100%. It's not an investment, right? Tax equity enables you to repurpose that tax liability into an investable asset and achieve a return that ultimately results in reducing your tax liability that you need to pay to the IRS. And there are two options that my company specializes in, and there are many others. Oops. But the two that I'll discuss today, first on the left-hand side, it is called a tax credit transfer. It is the opportunity to purchase a tax credit that's worth $1 in face value, so reducing your federal tax liability by $1 and purchasing that credit for some, material, non-trivial, but not massive discount to $1. Typically, those credits trade for 92 cents plus or minus 2 cents. So you would work with my company, BitGreen, or ETS, or somebody else in order to obtain these tax credits. You would make a purchase for 92 or 94 cents, and then you would immediately reduce your tax liability by $1. And you can do that both on April 15th or October 15th, whenever you file and pay, or you can also monetize these credits for your estimated payments. The other structure for effectively the same amount of risk and a little bit more work, tiny bit, is again tax equity. And this is a special purpose vehicle or an LLC that you would need to hold for anywhere from 5 to 10 years. And as you can see, the return scales proportionate with the amount of time that you remain in the vehicle. And this investment returns about 20 to 25% after 5 years, or 40 to 50% on an after-tax basis after 10 years. So how does this work? Let's talk about the first opportunity, structure number 1, which is a tax credit direct transfer. Very simply, the IRS sends tax credits to renewable energy developers when they place new infrastructure in the ground. It's a subsidy that enables them to stimulate growth and raise non-diluted project financing without having to sell a portion of the project to a private equity fund or a bank or another usurious investor. So the IRS provides anywhere from 30 to 40% of the project financing for renewable energy developers in the form of tax credits. However, those developers haven't built the project yet, so they in fact have no tax liability. They're not yet profitable. So they are able to transfer or sell that credit one time only to an individual tax-paying account that can utilize those credits. And you see that here in step 2. The developer, the solar developer in this case, sells the tax credit to a taxpayer, which there's a typo there, for 92 cents. And then the taxpayer reduces their IRS payment by $1. So immediately on day 1, the tax account is netting an 8% discount on their tax return, which is why I asked that initial question, why take market risk to eke out 6% per year on a pre-tax basis when focusing or at least evaluating this strategy can net you, 8% immediately. Strategy or option number 2 is tax equity. So this is an LLC where the physical asset, let's say a solar project, is sold into an investor holdco. That investor remains, the investor in this case, it's the taxpayer, right? Remains in the vehicle for 5 to 10 years, relatively passively. There's no work that needs to be done. And each year you receive a K-1 provided by us or another manager to your tax accountant, and you'll reduce your tax liability proportionate. After the 5 or 10 years, as an investor, you can choose to remain in that vehicle and receive a 5% dividend or cash pass-through from all of the revenue that is earned by the project or the sale of renewable energy, or you can choose to be bought out from your equity position. What do you receive in the tax equity investment as opposed to just the tax credit purchase? I've listed those benefits on the right-hand side. Number 1, you still receive all of the tax credits. However, you also receive the depreciable value of those assets, plus a preferred return and cash payments from the project itself. And if you choose at the end of 5 or 10 years, you receive a cash buyout of your position. And this is what the return profile looks like for that tax equity return. This models a $10 million tax credit purchase. So if you have $10 million or so in tax liability and you're looking to purchase those credits, you typically need to pay into the tax equity vehicle slightly more. In this case, it's $1.15 per tax credit. $11.5 million goes into the LLC. And for that, immediately you receive $10 million of tax credits in year 1. You also receive about $2 million or $2.5 million of federal and state depreciation. And this is on an effective cash basis that I've listed it here, assuming a 35% individual tax rate and whatever your state tax income tax rate is. Plus, you'll receive about $1 million in preferred cash and a buyout at the end of 5 years. Again, your after-tax return on investment, or I don't even really call it an investment since you're paying this money to the IRS anyway, but your multiple on that invested capital ranges anywhere from about 1.25 to 1.4, 1.5. And in my final slide, this is what the payout looks like over time. Again, tax equity, it's like a private equity return, but with the predictability of fixed income. In year one, you see there's an investment that's made. Immediately, you receive tax credits, depreciation, and you continue to receive a slice of that depreciation over the course of 5 years, plus a preferred cash return and state depreciation. And that's my conclusion. The problem that this solves is that you're likely overpaying the IRS. If you or your accountant or your tax attorney is unfamiliar with this program, it is seldomly understood because many did not read the Inflation Reduction Act. So the opportunity is to purchase tax credits directly or to get involved in a tax equity SPV. The expectation, if you enter into the tax credit transfer, it's about 6 to 10%, or for a little bit extra paperwork up front, you can participate in the tax equity SPV. It returns, 3 to 4x what you would get from a tax credit transfer, about 1.25 to 1.5x. And with that, I wanted to ask either Julio or Heidi, so much of this return is driven by depreciation, especially this federal depreciation. So could you explain to me and everyone else how an individual would be able to monetize depreciation, which is different than a tax credit, and what you might expect under now a Republican trifecta in Washington, what may happen to this depreciation, given that it is slated to ratchet down from a 60% bonus depreciation in year one to 40% next year?
Yeah, I mean, I'll let Heidi, she's, well-versed here, but I would say that depreciation is going to go immediately back to 100% on bonus depreciation, 179, and be restored. I think Heidi would agree with me that that's going to happen quickly. Heidi, what are your thoughts?
Yeah, I mean, word on the street is that that's going to be one of the quickest provisions to be included in the new tax reform bill, is expanding that. So to your point, Adam, taking that 100% bonus depreciation and being able to take the deduction for the cost of the solar project, which pretty much these solar projects are 100% eligible for bonus depreciation. They are not considered structural. These are building components. These are not building. These are equipment components, land improvements, all things that depreciate over a 20-year or less life cycle. Therefore, they qualify for bonus. So when we get back to 100% bonus, not only is there a tax credit that is applied to the cost of the projects, but there's also that subsequent deduction. So Adam, the interesting thing is reducing the income. What we are constantly talking about with our clients is what is active versus passive. We have a lot of passive incentives, tax credits and deductions that are going to apply for people who have significant investments and other passive activity or passive income that they want to offset. One of the things I think that your plan actually builds in is your tax equity vehicle, and correct me if I'm wrong, your tax equity vehicle has the ability to actually create active participation or material participation, which can then launch these tax credits and write-offs against any ordinary income that could be taxed at the top tax brackets. New York or California, they could be over 50% tax. So 100% bonus depreciation on the cost, you're coming in at a lower investment into a project, getting larger deductions than your original investment, offsetting ordinary income if we've got material participation. And that's really where a lot of our individual investors and family offices or high income earners are really looking at how the strategy can help them offset their high taxed income. So is that correct, Adam, with how, maybe talk a little bit about how you're actually achieving that, it's that threshold of how do we broach that wall of passive versus active?
Would you want to just define passive or active for anybody in the audience?
Sure. Yeah, absolutely. Years ago in the 80s, there was a bill that really was going to prevent individuals from using real estate and other investments as tax shelters. So they didn't want people to have something that they just sort of held out there as a passive investment. They didn't do anything, but yet they had massive tax benefits, depreciation, and write-offs. So they were using that to essentially pay zero tax. Therefore, they passed a bill in the 80s to create a line in the sand that breaks active or active income, which is what
like your W-2,
material
like your W-2,
participating
like
it is our regular job, our day-to-day, our W-2, the things we do to actively work and earn income. And then on the other side of the line are things that are passive. So you're not doing anything to generate it. You're making your money work for you, but that money is working for you passively. That when that occurs, you cannot apply that against all of that ordinary W-2 income unless you can achieve this material participation component. And so there are very, very few investments that can be made to actually cross that line. As I said, sort of break that barrier. So that's how I
Let me add to that, Heidi. Let me add to that a little bit, because the government tells us what to invest in to basically take advantage of these different programs that they create. And so what's unique here, and I just published my book, Why Millionaires Like the Tax Code, and basically we address this, but for certain investments out there, real estate, they wanted to stop the shelters, like Heidi said, in the 80s. So they made it so you had to be a material participant and spend 750 hours a year in real estate to take the tax benefits. Now, some families will, do that through having a spouse that participates and becomes the active person. So there's always ways to get to these objectives. But oil and gas, you can be active the first year and get the tax benefits. Why? Because the government wants people to invest in oil and gas. Same with solar, right? You can be active the first year and you're not active per se, but the government said, and the IRS acquiesced, that we're going to have lower limitations and participation so that people spend their money this way. So this is where Congress comes up with a rule. Film tax credits, 100 hours. So you can go on set, you can spend a week at the movie, and all of a sudden these tax credits, you get active participation. If you invest in endangered animals, another 100-hour participation, but you can go to the ranch, you can meet the endangered species, the zebra, the giraffes, and get that tax benefit, right? And only for 100 hours. So it is kind of defined between different tax investments and all directed at what the IRS and our Congress wants us to do, right? They give us the code. We just got to utilize it. And that's why I think we're doing this, webinar today, is to share with people that, yes, you can invest in certain assets and get a tax benefit. Certain assets are easier to invest in because the tax benefit can become active pretty quickly. And some don't need active participation, like oil and gas or some of the solar projects, because they give you that first year as active, no matter what the participation levels are. So interesting things, Adam, I just wanted to share that with you real quickly.
I loved that. In fact, I think this is why it's so valuable. And I just learned about the endangered species tax credit and visiting the zebras. And you're right. The IRS and the US government via the Treasury has actually given us the game plan. They've showed us the golden road toward monetizing and optimizing our tax portfolio to take advantage of these programs. Some of them require, searching around with a magnifying glass, because they're not available to everyday citizens everywhere, particularly if they're just merely a W-2 or a 1099 worker. And as Heidi alluded to, in the 1980s, it was too easy to take advantage of these programs. And so people figured it out and they weren't paying any tax, right? And so you do need to take some effort, right? And also whoever you're working with as an individual taxpayer, whoever's advising you on tax optimization, you want them to be familiarized with these programs, or maybe even more than familiarized. You want them to be an actual surgeon and have this be their specialty, right? That's what's crucial. And I would say that of all of the calls that I've taken with high net worth individuals, family offices, even some public company tax directors, invariably, they always say, why did my tax accountant tell me about this? And it's because tax accountant just wasn't as up to speed on it, because your family may be a niche and unique use case for them, right? As opposed to all of the other cases that they're handling. And so they just missed it, not because they're bad at their job, but they just don't specialize in engineering these type of strategies. And I think that's
Yeah,
a really
I would
crucial-
agree with that, Adam. And I would say that I think the most important thing we have to share with the audience today is you have 40 days left to lower your taxes for 2024.
Right.
And by the
That's
time
right.
it hits midnight on New Year's Eve, you know, a lot of what you can do, you can't do anymore. So the biggest thing I would tell people is start getting with your accountant, start doing tax planning, because 40 days is not a lot of time, especially if
That might be a great
participation
way.
programs.
That may be a great segue to, I
Yeah.
think we have 10 minutes for Q&A, but can you explain why that cutoff, December 31st at midnight? Like, what is the significance of a calendar year for some of these programs?
Yeah,
Why
because
can't I think in April?
Yeah, because that's a good question, because most companies file on a calendar year, right? Not every company, right, Adam? So some, you know, have a different year end, but for most people, all individuals, it's 12/31, and then corporations, 90% of them are year end, 12/31. So that's big because we record all the income we made through 12/31 for IRS purposes, and then all expenses, and we net it out to see what the profit is to calculate our taxes. And so that's a big date. I mean, there are a few things you can do post 12/31 to lower your taxes. You know, you can still do a cost segregation study and do that before you file your tax return. Same with the R&D tax credit studies. But some of these investments you have to make, you have to do by 12/31 or they're disallowed for that year. So it's
Right.
time
And some of
people
these
start
tax
talking to
credits.
Adam and Heidi right away. Yeah.
Yeah.
Yeah, and if people are interested in tax credits, for example, right, those credits that you need to acquire credits of the same vintage year in which you want to offset your taxes. So if next year you're looking to offset your 2024 income tax liability, you need to actually buy a 2024 tax credit, which becomes scarcer and scarcer as we approach April 15th.
That's a good point, Adam. And you know, what you're saying too is like, you know, the tax credit inventory starts to go down as people, you know, start really, you know, a lot of people start like this 2 weeks before the end of the year. But then
Right.
the benefits go down, right? Because the prices go up, right? Because of less inventory. Good point.
There's a run on the prices. It's kind of like
Yeah.
walking into the Halloween store on October 31st after work, and when like all the good costumes are gone. And that's
Yeah, a lot
that's
different on
exactly
November
what
1st,
happens.
right? Yeah.
Yeah, right.
Well,
Yeah.
well,
You get
and to
great
that point,
costumes.
so it's not only that. Another thing that I've been seeing for the last really 2 months. I'm a real estate investor. Julio's a real estate investor. As I'd mentioned, I mean, real estate is one of the best vehicles. However, we're in a changing time. Real estate cap rates, interest rates, insurance rates. I mean, that the costs, building code costs, labor costs, everything is so much higher than it's been. You start to look at deals, cap rates are not ideal. And so for the first time in many years, many of our investors who have primarily looked at strategically buying real estate before 12/31, getting it placed in service, having the activity to be able to use the depreciation, they can't find the projects, or those projects don't pencil out in a way that's advantageous for them right now. So some of these programs, like Adam, what you have, and again, what Julio was mentioning with the wildlife funds and oil and gas and some of these things, they have been incredible vehicles to essentially bridge the gap between where we are in the economy with inflation and rising costs and lower cap rates, to help people have an alternative option. For, you know, they've been buying real estate every single year. That's an amazing vehicle. But right now, things are a little touchy. And so they have just been a really nice way to diversify, have something different. And then one other point, Adam, I wanted to ask, on the corporate side, and correct me if I'm wrong, because I'm still trying to understand all the solar stuff, isn't the investment also going, like for a corporation, doesn't it go towards their sustainability requirements? Like there's some regulations that they have to have a certain amount towards sustainability or something?
That's a really great point. Right now, there's no federal regulation at the
Okay.
federal level, and that is one area that I would not anticipate movement over the next 4 years.
Yeah.
However, at the state level, if you're a company that does business in California, for example, right? California last year passed a law that, get this, every company in the state of California, over $100 million of revenue, which is many, irrespective of whether you are a US domestic company or you are international, you will need to publicly disclose your carbon and audit your carbon production each year. So, and effectively what will happen is this will become kind of the keystone or the foundation for future regulation that forces companies to offset with either carbon credits, renewable energy credits, or something else. So, but companies are using these renewable energy tax credits to then also make a claim in their 10K filing, right? And on their earnings calls, brandishing their green credentials and saying, look, we built this solar facility in a low and middle income or tribal area. And the truth is, the CFO made a smart financial decision, right? One that we would expect. But as Julio said, right, that money was directed to a place in the economy that the government wanted to incentivize and stimulate growth. So it's kind of a dual action benefit for those corporations.
Yep, absolutely.
All right. I would keep going with the two of you, but maybe some folks in the audience or Katherine or Alexander have any questions before we wrap up.
Yeah, absolutely. So anybody who's in attendance, please raise your hand and ask a question, but also this is going to be recorded. And so I am going to provide all of your contact details at the end because I know there's so much information here. But, you know, one of the things is practically like, what steps could I take this year? I got 40 days left. What should I do next? What are some practical next steps to say, okay, how can I take advantage of these programs? And then Alexander, he popped on, so I think he has a question too.
Well, I can jump in then.
Do you want to answer? Do you guys want to answer that quickly?
Yeah, I'll answer just really question, Katherine. Yeah, I mean, before year end, we are working diligently on helping people look at those tax advantaged opportunities and alternative investments. So if people have questions and they're not familiar with some of these vehicles we discussed, reach out to myself or Julio, and we can absolutely look at what options are really going to be ideal for that situation, including Adam's package and how all this rolls together, or contact Adam on the solar deals. And it's just a matter of looking at it, reviewing the due diligence, and then being able to understand how the tax credits and the depreciation flow to you personally, and then what the cash value is from a tax savings standpoint and how that whole thing pencils out. So there's some really great planning strategies that are available from either of our groups.
Great. And Alexander, you had a question. Oh, I need to unmute you. You know, this is the power you have.
Oh, here him. Can you hear me? Okay, sorry.
I can mute him. Please, love.
No,
go
thank
ahead.
you. Thank you all so much. This has been such an informative presentation, and it reminds me, I remember starting to study tax when in law school, and I quickly pivoted away from that as fast as possible due to the labyrinthian network I was going into with that. So thank you for making so much of this more comprehensible. And I had, you know, I actively look for things like this for some of the families we work with, and I had no idea about some of these opportunities. 40 days counting down, of course, but just also looking ahead to the next year. If a family wants to engage and start getting things prepared for next year ahead of time, what do they need to have ready? They walk into your office. What do you need to have from them at the ready? And about how long does it take to kind of get them up and running and possibly in a working situation? I know this can vary, of course, depending upon assets, et cetera, but just maybe kind of a for instance, based upon current clients, that would be very helpful to hear.
Yeah, absolutely. We have an onboarding form that we like to begin with, and it is somewhat comprehensive. One of the first things we want to see is a copy of the tax return. It's amazing what we can find. It's like a treasure trove of information. So reviewing the tax return and then really looking at projections for what total income is going to be for the year, what's changing in terms of ownership or partnerships or shares held within different companies and how their investment packages all rolled together. So we review all of that data to really understand comprehensively and organically everything that is existing in the portfolio. From there, we then schedule a couple of calls and present a number of opportunities. We have certain people that just have interests or have some experience in certain areas than others. Some are not familiar with real estate, and that feels a little bit overwhelming, but maybe they have a background with oil and gas. Or I actually had a couple who felt very uncomfortable with oil and gas. It was just completely foreign idea, but they loved the idea of the wildlife fund because it actually resonated with them in terms of ranching and farming. And so it's not only how the deals pencil out, it's what resonates and what makes sense, what's a little easier to understand in terms of a structure, or what you feel even personally interested in investing in, because we do buy into some of these things. The solar and sustainability programs are making an impact in our country. And so we really look at that again holistically. So to answer your question, we look at that total process. If we're looking at something within 40 days, we're typically providing some immediate solutions that can be acted on right away. Beginning next year, when we have time, we look at a more strategic plan that likely will take, probably 4 to 6 or 7 weeks to really start to formulate and decide what the next steps are.
And from my side, I think the distinction is that ETS, that sounded very diagnostic, and holistic is the key word, right? And optimizing the account's whole portfolio. We're more surgical, or we're more like an antibiotic. Like we have this one product that is extremely effective at reducing tax rate using these renewable energy and solar tax credits. That's where we specialize. For an individual to work with us, my first question on the call would typically be, how much in federal tax did you pay last year? And how much of that might have been passive, how much may have been active? And knowing that information is, or what may change for 2025, for example, that's the crucial question that I typically ask up front.
Okay, excellent.
Wonderful.
Thank you.
Well, thank you, everyone. I mean, we've gone over because there's so much here. So obviously the contact information is on the screen. Please reach out with questions, but we're so lucky at, I think we might think about doing this again next quarter to see what changes have happened. But really, I want to thank Adam and Heidi and Julio, and it's wonderful to share your time and expertise with our audience, because these are things that a lot of people may have missed, or even an average accountant may not know about. But that's why we go to the best and we get the experts to tell us. But it's a pretty exciting area. So thank you, everyone, for your time, and I'm wishing everybody a happy Thanksgiving, and look forward to seeing you again soon.
Happy Thanksgiving, everyone. Yeah.
Bye-bye.